At the heart of this analysis lies a fundamental and unsettling contradiction that is currently paralyzing trader intuition and algorithmic models alike. On one side, we have a suite of recent macroeconomic data that, by all traditional financial playbooks, should be launching a tidal wave of bullish momentum into risk-sensitive asset classes like cryptocurrency. The headline figure is a pronounced, unexpected drop in the consumer price index, pushing core inflation to multi-year lows. This isn't just a minor statistical blip. It's a data point that speaks directly to the primary mandate of central banks, particularly the U.S. Federal Reserve. The immediate narrative this spawns is one of imminent monetary policy relief. Lower inflation readings provide the essential cover for central bankers to pivot from a stance of restraint. Quantitative tightening and elevated interest rates to one of stimulation. The logical chain reaction is clear. Falling inflation begets anticipated rate cuts. Rate cuts increase systemic liquidity, and that freshly printed capital in search of yield historically floods into the highest growth, highest risk segments of the market. By this century-old script, the current moment should be the opening scene of a roaring crypto bull run, with capital rotation out of safe havens and into digital assets accelerating by the day. Yet the opposing side of this equation presents a starkly different reality, one painted in the deep red of crashing portfolio valuations. Despite the ostensibly green light from macro data, cryptocurrency markets are not rallying. They are languishing or falling further. Bitcoin, the sector bellwether, remains stubbornly below key psychological levels, and major altcoins have bled out significant percentages from their yearly highs. This divergence creates a cognitive dissonance for anyone watching both the economic news ticker and their trading terminal. It's as if the market has been given the all-clear signal to launch, but the rocket's engines are failing to ignite. This isn't merely a lag or a minor disconnect. It is a profound and glaring paradox that signals one of two possibilities. Either our reading of the macroeconomic data is critically flawed, or the fundamental drivers of the cryptocurrency market have undergone a seismic shift that renders the old playbook obsolete. This contradiction is more than just a curious anomaly. It is a central puzzle that demands rigorous deconstruction. For the astute investor, such a blatant divergence between signal and price action is not a reason for confusion, but for intense focus. These are the moments where market inefficiencies are born, where herd mentality blindly follows one narrative while a deeper, more complex truth remains uncovered. The why behind this disconnect holds the key to monumental risk management and generational opportunity. Is the market, in its collective wisdom, pricing in a hidden truth behind the rosy inflation numbers? Is there a second-order effect, such as impending recessionary fears triggered by the very rate cuts meant to stimulate? Or has the correlation between traditional macro liquidity and crypto asset prices broken down entirely under the weight of new, dominant market participants? Therefore, the core investigative mission becomes a forensic examination of both sides of this ledger. We must ruthlessly interrogate the quality and completeness of the bullish macro data, asking what it might be hiding. Simultaneously, we must decode the bearish language of the price charts to understand what story they are truly telling about future liquidity, investor sentiment, and structural changes within the crypto ecosystem itself. Resolving this macro contradiction is not an academic exercise. It is the essential first step in determining whether we are standing at the precipice of a final brutal shakeout before a historic rally, or at the early stages of a new, deeper bear market that the headline data has yet to acknowledge. The path forward for any strategic portfolio depends entirely on which side of this contradiction proves to be the illusion. The initial bullish signal from falling inflation data rests on a precarious and often unexamined assumption that the numbers presented are a complete, accurate, and an unequivocal reflection of economic reality. This keynote argues for a posture of profound skepticism, asserting that the foundation of the current bullish macro narrative is structurally unsound. To blindly trust the headline figure is to ignore the well-documented complexities, methodologies, and potential for political and institutional bias embedded within its construction. The market's failure to rally on this news may, in fact, be a sign of its sophisticated understanding that the surface-level story is misleading. Firstly, we must address the issue of data integrity and revision risk. The process of collecting the vast array of price information that comprises the Consumer Price Index is monumental and inherently prone to gaps. As noted by some data analysts, the collection window for the recent period in question was not seamless. There were acknowledged interruptions and missing data points. In statistical terms, this means the initial report is a provisional estimate, not a final verdict. Markets with institutional memory know that such provisional estimates are frequently revised in subsequent months, sometimes significantly. A shock drop today could be softened or even reversed by a revision tomorrow. Therefore, the rational market reaction is not to front-run a bullish thesis on provisional data, but to adopt a wait-and-see approach, discounting the initial euphoria until the numbers are hardened. This inherent skepticism acts as an anchor on any sustained bullish momentum from the report. Moving beyond collection gaps, we must interrogate the composition of the inflation decline. A steep drop in the headline number is often driven by volatile components like energy prices, exemplified by plummeting gasoline costs. While this provides temporary relief for consumers, it masks more persistent and troubling trends within the core measures. The script highlights the critical anomaly of core goods inflation. Historically, due to technological advancement and globalized supply chains, this category has often experienced negative inflation-deflation. The fact that it remains stubbornly positive is a massive red flag. This persistent positivity is widely attributed to the lingering and potentially escalating effects of global tariffs. Tariffs act as a direct structural cost increase embedded into goods, resisting the typical disinflationary pressures. This creates a dangerous two-tiered reality, a falling headline number that fuels political and central bank narratives of victory, while an underlying tariff-driven inflation in core goods continues to erode purchasing power and business margins. The market, sensing this dichotomy, reacts to the more persistent core reality rather than the transient headline. Finally, this leads to the core issue of narrative control and market trust. The publication of economic data is not a sterile scientific exercise. It is a powerful tool for shaping expectations and behavior. When a headline figure appears to contradict the lived experience of consumers and businesses who still feel the bite of high costs in key areas, a credibility gap emerges. This gap fosters a don't trust, verify mentality among professional investors. They begin to look past the official narrative, seeking alternative data sources like real-time shipping costs, input price surveys, and corporate earnings call commentary about margin pressures. The cryptocurrency market, populated by a demographic deeply skeptical of centralized narratives and traditional financial institutions, is arguably one of the most sensitive to this credibility gap. For crypto traders, a bullish narrative built on what they perceive as flawed or manipulated government data holds no persuasive power. Their selling pressure, therefore, is not just a reaction to price charts. It is a vote of no confidence in the story being sold. Therefore, questioning the data is not cynicism, it is due diligence. The market's tepid response to seemingly bullish news is a powerful signal in itself. It tells us that a significant cohort of capital is looking through the headline and seeing a more complex, less optimistic picture, one of unreliable provisional data, stubborn underlying inflationary pressures from geopolitical policy, tariffs, and a growing distrust in the official narrative. This creates a fragile environment where any negative surprise, a hawkish central bank comment, a hot revision to the data, a spike in commodity prices can trigger outsized selling as the thin veneer of bullish confidence shatters. The bearish price action in crypto, therefore, may be the canary in the coal mine, warning of a broader loss of faith in the story that is supposed to be driving the next bull market. Until the data is seen as robust, complete, and reflective of a true sustainable disinflationary trend, the market will likely withhold its trust and its capital. The year 2025 was supposed to be a coronation, According to the long-revered and deeply ingrained four-year cycle theory, this period, approximately 4 years after the 2021 peak, was predestined to be the explosive parabolic heart of a new crypto bull market. This model, built on patterns from 2013, 2017, and 2021, offered a comforting, almost rhythmic predictability to the chaos of digital asset markets. Yet, as the year unfolded, this sacred cycle didn't just underperform, it shattered. This keynote posits that the market's behavior in 2025 is not a delay or a minor deviation, but a definitive funeral for the old, retail-dominated crypto cycle. In its place, a new, more complex, and institutionally dominated playbook is being written. We are witnessing a fundamental paradigm shift in what drives crypto asset prices. The evidence of the cycle's demise is stark and statistical. A true four-year cycle bullish year should produce a dominant, overwhelmingly green monthly candle on Bitcoin's chart, reflecting sustained buying pressure and exponential gains. Instead, 2025 is poised to close with a bearish or indecisive red doji candle. This is not a matter of degree, it's a categorical failure of the pattern. This disappointment extends universally. Ethereum's chart is similarly bearish, and the carnage across major altcoins like Chainlink, Cardano, and Uniswap is severe. When an entire asset class in its most crucial predicted year moves in direct opposition to a multi-decade pattern, it is a signal that the underlying forces powering that pattern have changed. Relying on this broken model now is not analysis, it is astrology. We must diagnose the cause of death to understand the new market organism. The autopsy reveals a clear culprit, the complete colonization of the crypto market by institutional capital and its accompanying Wall Street rulebook. The previous cycles were driven by retail speculation, technological hype cycles, and a market largely isolated from traditional finance. The 2021 cycle's peak coincided with the final, massive wave of retail euphoria. Since then, the landscape has been irrevocably altered by the introduction of spot Bitcoin ETF, the entrance of legacy asset managers, hedge funds, and corporate treasuries, and the integration of crypto into regulated financial infrastructure. This new dominant player, the institution, does not think in four-year cycles based on Bitcoin halvings. It thinks in terms of macroeconomic liquidity, regulatory risk, portfolio correlation, and basis trades. This changes everything. The old cycle was powered by a collective, crowdsourced narrative. The new market is driven by the cold calculus of institutional risk desks. Their decisions are not based on historical crypto charts, but on the same signals that move the S&P 500. Federal Reserve dot plots, Treasury yield curves, the VIX index, and global liquidity measures. This is why the script points to a crucial new analytical framework. Observe the behavior of risk assets during periods of monetary easing. The historical correlation is ironclad. When central banks pivot dovish and liquidity floods the system, speculative assets rise. The four-year cycle was, in hindsight, largely a coincidental proxy for this macro liquidity cycle. Years like 2013, 2017, and 2021 were, indeed, periods of ultra-accommodative policy. 2025 was a year of tightening and quantitative contraction, hence the bearish result. The cycle wasn't wrong about price direction. It was simply tracking a deeper, more fundamental driver, liquidity, through the crude lens of past Bitcoin halving dates. Consequently, the rules of engagement have been rewritten. Retail traders can no longer simply buy the halving and wait. They are now competing in an arena where prices can be suppressed for extended periods through sophisticated instruments like futures, options, and ETF flows that were non-existent in prior cycles. This creates a market of false technical breaks and prolonged manipulative consolidation, phenomena common in equities but new to crypto. The wall of worry the market must climb is no longer just about Bitcoin's energy use. It's about the Bank of Japan's yield curve control, the stability of the U.S. banking system, and the wording of a Senate subcommittee report. In this new paradigm, success requires a dual lens. One, I must remain on the traditional crypto chart, respecting its support and resistance levels born from years of collective memory. But the other, I must now be firmly locked on the Bloomberg terminal, watching for shifts in global dollar liquidity, central bank balance sheets, and the risk-on, risk-off flows of the traditional investment world. The death of the old 4-year cycle is, therefore, not a cause for despair, but a call to intellectual arm. It marks crypto's painful, necessary graduation from a speculative internet experiment to a legitimate, if volatile, asset class playing by the complex, high-stakes rules of global macro finance. The next bull run will not be announced by a countdown to a halving, but by a pivot in the Federal Reserve statement and the re-leveraging of the institutional balance sheet. Gone are the days of passive, faith-based investing anchored to a distant halving date. The shattering of the 4-year cycle and the ascendancy of institutional market mechanics demand a new, proactive, and highly tactical approach. This keynote outlines a catalyst-driven playbook, a structured framework for navigating a market where price is no longer a function of predictable time, but of discrete, high-impact informational events. In this new epoch, success belongs not to the patient holder, but to the prepared tactician who identifies, anticipates, and strategically positions around the specific triggers that move the needle of institutional capital. The core tenet of this playbook is that major price inflection points are now directly tied to identifiable catalysts, not cyclical milestones. The recent history of crypto provides a clear blueprint. Consider the explosive moves surrounding the spot Bitcoin ETF approval. Months of sideways consolidation, followed by a final pre-announcement sell-off culminating in a violent upside breakout on the news. Observe the reaction to the U.S. election, a period of anxious stagnation resolving into a sharp rally upon the certainty of the outcome. This pattern, consolidation, pre-catalyst shakeout, explosive resolution, has repeated itself. It is the signature rhythm of a market where large concentrated capital waits for regulatory or policy clarity before committing. Recognizing this rhythm is the first. The current market phase of depressing low-volume price action is not random. It is the predictable consolidation stage, setting the stage for the next catalyst-driven move. This framework requires us to move from vague hope to specific catalyst identification and monitoring. The playbook currently highlights 2 immediate high-probability catalysts. Monetary policy tone from global central banks. The Bank of Japan pivot. The specific event analyzed is not just whether the Bank of Japan hikes rates, but the language its governor uses. A dovish tilt suggesting an end to global tightening is a direct buy signal for all risk assets as it promises increased global liquidity. A hawkish or uncertain tone extends the pain. This exemplifies the new analysis required, parsing central bank communiques for hints of a coordinated global pivot. U.S. regulatory clarity, the market structure bill, progress on definitive crypto legislation, particularly a bill that provides a clear regulatory framework, is a release valve catalyst. It removes a major overhang of uncertainty that has paralyzed institutional deployment. The timing of committee votes, key supporter comments, and legislative markups become critical data points more important than any technical indicator on a chart. With the catalysts identified, the playbook moves to strategic positioning, not prediction. This is where it diverges from passive hodling. It involves setting precise, non-emotional orders at technically defined levels in anticipation of the catalyst's outcome. The script provides a clear example. For Ethereum, the analysis defines a critical support zone near $2,800. The playbook instructs, place a buy order here. If this level holds on a dovish catalyst, it confirms a local bottom. However, acknowledging potential volatility, it also defines a secondary, stronger demand zone near $2,500. The instruction, place a larger contingency buy order here. This is not wishful thinking. It is a mechanical strategy to accumulate assets at levels the institutional flow seeking value after a shakeout is likely to defend. For an asset like XRP, the analysis translates chart structure into a potential target of 16 cents, a key historical level. The Playbook's directive is not to fear this drop, but to prepare for it as an opportunity, placing buy limit orders to automate the entry. This approach transforms the trader's psychology. The anxiety of watching the charts is replaced by the discipline of a preset plan. The shakeout phase, which demoralizes the crowd, becomes a welcomed event for the tactician with dry powder and resting orders. The final explosive resolution phase is not a surprise to be chased, but a planned outcome to be managed. A time to take partial profits and reassess for the next catalyst in the chain. Ultimately, this catalyst-driven playbook reframes the market from a mysterious cyclical force into a series of solvable puzzles. It demands continuous research into macro policy and Washington politics. It requires disciplined technical analysis to identify high-probability entry zones. And it replaces faith with a systematic process. Identify the next major catalyst. Define the price levels that will offer value before and after its resolution. Set your orders. Then let the narrative unfold. In doing so, the investor no longer rides the wave of market sentiment, but navigates it with a map and a compass, turning the heightened volatility of this new institutional era from a source of risk into a structured field of opportunity.